As summer 2021 comes to a close and we're approaching the start of the fall sales season, there are a lot of questions about the future of the housing market. In today's Hard Money Minute, I'll discuss the factors at play in today's market. First, let's talk about some reasons why housing has some strong foundations. Like all economic principles, the heart of the housing market is based on supply and demand. Let's look at supply. We've had an inventory problem even before the effects of COVID-19 restrictions. These issues amplified with shutdown orders that prevented showings and sales. But by the fall of 2020, inventory bottomed out at all-time historic lows, reaching just 3.5 months of inventory nationally. As a result, we saw bidding wars and price increases of 28.5% in the 2 years from 2019 through today. The inventory shortage has many causes. For more than 13 years, we've not built enough houses. This year, we've had the largest number of new residential housing starts since 2006. But since 2006, we built less homes than the 50-year average for demand. As a result, there just aren't enough houses for the demand. It's going to take several years for new builds to catch up. Many real estate professionals have been waiting for the conclusion of the mortgage forbearance efforts designed to ward off the bank foreclosures during COVID-19. Governmental efforts have largely been successful. More than 9 million households have taken advantage of these moratoriums, and the number of delinquent homeowners has dropped from around 20 million to only about 1.75 million nationally. Even as moratoriums are slated to end on September 30th, it's unlikely that we'll see a large influx of bank REOs hitting the market before spring or even fall of 2022. Oddly enough, inventory climbed to 6.3 months in June, which is much closer to a balanced market. Demand remains strong. As COVID-19 restrictions were eased at the end of last summer, buyers were out in droves fueled by uber low interest rates. Competition for nice properties outpaced supply very, very quickly. The result was an increase in property values. So I've just covered what you probably already know. So what comes next? Now, the housing market has predictably followed a 10-year debt cycle. The debt cycle shows the ebb and flow of supply and demand, i.e., the fluctuation of housing prices. If we assume that the last cycle started in 2010, or that was the bottom, that's when prices were at the bottom, then we are in year 11 of the cycle. So it's likely that we'll see a pricing downturn coming soon. Some market watchers feel that we're headed for a catastrophic collapse even larger than what we saw in 2008. These people point to two major factors. One is the inflation adjusted housing price index, and the second is house price to median income index. The inflation adjusted housing price index evaluates how much house prices have risen relative to the prices in the economy for other goods and services. It currently stands at 94.6, which is the highest reading in history. For context, the indices of March 2006 was only 92.3. There's better news in the from the house price to median income index. This index measures the affordability of housing relative to the average salary. The good news here is that it's only the second highest reading in history, coming in at 6.7 versus a high of 7 in November of 2005. In addition to these indices, there's some troubling predictions coming from hedge fund manager Michael Burry. You might remember Michael Burry. He's the eccentric fund manager from The Big Short. He's the guy with the glass eye. He's the one that saw the crash coming before anybody else. And he's been calling for the mother of all crashes in the financial markets since June. Since housing is inevitably tied to the economy, we should see some major problems on the horizon. Now, we learned a lot from the errors of 2008. Bank loans are a lot safer now than what we saw before the crash. In fact, more than 40% of all single-family homes, they don't even have a mortgage. Low interest rates will continue to keep housing costs affordable even as prices rise. And even though the Fed has indicated a coming increase in these ridiculously low interest rates, they're not likely to do so overnight. The forecast for housing looks stable, but most people thought that in 2006. While all indicators seem to point to stability, there's always the black swan that no one sees coming. That's why it's important, if you're a real estate investor or home buyer, to think long term. Make sure your investments cash flow, plan to stay in your property for the next 10 years. If that's your play, things look pretty safe. But if you're flipping houses, the key is going to be getting in and out quickly. Say no to large renovation projects. Manage those contractors and make sure that you price it right when it hits the market. You can't be certain of what the future holds, but we can plan appropriately so that we don't get stuck without a chair when the band stops playing.